The term smart money refers to the capital that is under the management of institutional investors, central banks, and various other professionals or financial institutions. It is handled by seasoned investors who are able to anticipate shifts in the market and maximize profits as a result. The term smart money originated in the world of gambling, where it was used to describe gamblers who either had significant knowledge of the activity in which they were participating or had access to insider information that was unavailable to the general public. Here, before we begin, subscribe to our channel for more updates. Let's get into it. The wise investment. Cash that is invested with investment professionals that are either more knowledgeable or more experienced, or both, is referred to as smart money. It is believed that these funds are invested at the appropriate moment and in the appropriate investment vehicle, which will result in the maximum possible returns. Because institutional investors are thought to have superior investing methods that differ from those of regular investors, it is believed that smart money has a greater probability of success. This is because institutional investors are referred to as smart money. When central banks exercise control over smart money, it enables those institutions to move markets with scale and force. After that, it turns into a combined force of significant sums of money and sound strategy, with those investors riding on the success of wise money. In this context, the term smart money refers to the capital that is under the management of institutional investors, central banks, and many other financial institutions or specialists. A collective force that possesses the power to move markets is referred to as smart money. It is commonly held that institutional investors, or smart money, have a higher probability of success than regular investors. Identification of intelligent investments. It is possible to recognize behaviors using smart money by using the following sources. Trading volume. When there is an exceptionally high trading volume in a stock, but there has been no industry news or public information to generate the volume, smart money may be moving into a position. Smart money may be moving into a position when there is an unusually high trading volume in a stock. The cost of stocks and the index choices. Investors that have a greater depth of knowledge might learn about smart money by studying index options and stock pricing. The information obtained from these sources gives an idea of how sophisticated investors are preparing their positions for future trades. Therefore, it would be beneficial for regular investors to anticipate the positions of smart money and the securities that they are trading. This would allow them to take advanced positions and ride the wave to financial success. The many techniques and sources of the data. Data providers utilize a variety of methodologies and sources of data in order to categorize trading actions into groups of knowledgeable and non-informed traders. In order to differentiate between commercial and non-commercial trading operations, analysts make use of data reports from various sources, such as the Commitment of Traders (COT) report. These types of data sources shed insight on the disparity between the two parties' approaches to staking out their respective positions in the market. On the other hand, it is important to note that investing activity alone is not sufficient to convey the full intent of these investors. The Intelligent Money Index. The performance of smart money in the stock market as compared to the performance of dumb money, which is a reference to the money invested by retail investors, can be understood with the help of the Smart Money Index. The price action of the market is evaluated throughout the trading day by institutional investors. As a result, smart money trades throughout each and every hour of each and every trading day. On the other hand, the majority of transactions involving dumb money take place at the opening of the trading day because it reacts to the overnight news, early morning news, or economic data. Applications of the Smart Money Index. Traders put the Smart Money Index to work for them in two different ways. Confirmation of asset trend. The Smart Money Index does not indicate when to trade in the specific assets. Rather, it indicates what an investor can expect from the assets in the short term. This is because the Smart Money Index is not based on market timing. In the case of an asset that has been moving in an upward direction, for instance, the Smart Money Index may provide an early warning before the trend reverses. Changes in the Smart Money Index and the general direction of the market. The patterns that are suggested by the Smart Money Index are closely watched by investors, and any deviations from those trends are looked for. The process is referred to as identifying of divergence. When the price of an asset goes down while the smart money index continues to rise higher, this is typically indicative that the price has room to climb higher in the future. Pros of SMC. It would appear that trading using smart money concepts is successful for some traders. There is no justification for avoiding its use if it is successful for you. It is more important to be able to consistently grasp what price is doing and profit from its behavior than it is to understand why price is moving in the way that it is moving. Price action has a long history of producing results for many different people across a wide range of assets, including currencies, as well as other types of assets. Because SMC is simply repackaged price action, it does have a strong foundation at its center. When presented in SMC format, the price action can be simpler for some individuals to comprehend. Although the hypothesis that large institutions are going after retail traders is highly improbable, it is not completely out of the question to suppose that larger institutions may on occasion go after smaller ones, which may be the source of some of what we are witnessing. Even though SMC is presenting them in a framework that is open to interpretation, liquidity grabs are a real phenomenon. Therefore, it is possible that some of the SMC theory's components have some basis in reality, but not in the way that SMC describes them. Cons of using SMC. When one considers, from a logical standpoint, the insignificance of retail traders in comparison to the major players in the market, certain aspects of the SMC theory do not appear to make very much sense. If one is to believe everything that is presented by SMC with complete conviction, this could lead to a misunderstanding of the fundamentals of the market. The theories that underpin SMC are impossible to either prove or disprove. They are based entirely on conjecture, and the only person who would be able to produce concrete evidence in support of either position would be an insider. This indicates that no one can prove that the SMC's model of reality is accurate, but that no one can also prove that it is completely false, either. Arguments can only be made based on one's personal beliefs regarding the actions of various institutions. This is it for today's video. Make sure to subscribe to our channel for further updates. Also share with us what do you think about smart money concept.